Hi, everyone. It is Thursday, February 9th, 2023. Welcome to TechTO Quick Takes. I'm your host, Alex Reilly, and here are today's headlines. We dive into the latest news surrounding D-Wave, and we discuss the largest raise of 2023 so far. And for our lightning round, Shopify making another investment, and New School Food swims to a raise. And Alex Norman joins me to break it down. Hi, Alex.
Hey, Alex, how you doing?
I'm great. How are you?
Pretty good. It's a bit wet outside, but I'll take that. It's like
Yeah,
unseasonably warm and wet.
exactly. At least it's in the positive temperatures, and we're not dealing with that cold anymore. So ups and downs with it, but
Just like the tech market.
constantly, right?
Yeah.
Like that's all we've been talking about over the last like 6 months. It's just the ups and downs. So that's why I'm excited by, especially the second headline we're going to get into. Largest race to kick off the year. So that's great, and I'm looking forward to learning more about that. Before we get into that, I want to discuss the D Wave news with you and just the rumors surrounding that and what's going on there. So, for anyone that's listening that is not sure what that's regarding, why don't you start by breaking down just maybe what the rumor is around that?
Okay. So, according to investors and reported by the Global Mail, Berkeley-based D-Wave Quantum is having liquidity issues. What that means when people say you're having liquidity issues, that means they may have trouble paying their bills, and they either have to raise additional funding in the near term, or they could be forced to sell the company or shut down. So they're publicly traded, and this is quite significant to hear rumors that you're having liquidity issues.
And one of the things that's interesting, or I guess worrisome, is they went public. And so it's just how did they get into this position, especially after going public?
Okay, so it's a series of misfortunate events is the best way to
Okay,
explain it, and you're gonna have to give me patience because I'll try to take it step by step.
sure.
So
Yeah,
yeah,
let's take step by step for us.
so D-Wave went public via SPAC last year.
Okay.
But the SPAC was relatively unsuccessful despite D-Wave being a leader in quantum and quantum being a hot space. To give you some context before that happened, or in total, D-Wave has raised 350 million plus US dollars from investors, has received tens of millions of dollars in federal aid. But if you look at their history, they're 24 years old. They've never really had an easy time raising. So so that's a bit of context. And so let's go through what actually happened here.
Yep.
They're in a precarious situation because they said, okay, we need cash. We're a leader in the quantum space. We're going to, merge with a SPAC company. And the idea was that they're going to raise between the SPAC cash that was sitting on the SPAC's balance sheet
Okay.
and private investors 340 million USD. So what happened is they raised only 39 million USD. They raised a bit less from investors, but the big shortfall
Mhm.
came from SPAC holders because when a SPAC announces a merger, you're able to redeem your shares for more or less the initial investment you put. So most of the investors said, we don't want to get into D-Wave. And, it was like some nominal amount that came from the SPAC. So you raised 39 million, you had transactions cost of 11.5 million because
Yep.
you have to pay the bankers, you have to pay the
Yep.
consultants. They had venture debt of 20 plus million dollars, which had to be repaid when they went public. So that, if you look at it, just at the basic 31.5 million in repayments and expenses and 39 million raised, this something that they thought would raise net them like 300 million plus, none of them like $8 million.
Okay.
So
Yeah. So did not pan out at
did
all.
not pan out. But
Yep.
and I think credit to the CEO and the
Mhm.
team. They saw that these things weren't going their way, and before they went public, they arranged a line of credit for up to 150 million USD. Now, so that means it's like people get that line of credit against their house. You can take money out. Um, it doesn't come unfettered. You can't just take money out when you want. So first of all, D-Wave had to pay 2.6 million commitment to have that money sitting there. Then they
Mhm.
had rules. They said, hey, you can only take so much out on a daily basis. So you can't take out all 150 million at once. Um, in exchange for providing us, not only going to pay interest, but we get ownership via shares for all the money you borrow.
Mhm.
But we can never own more than 9.9% of D-Wave. And for you to use a line of credit, your share has to be more than $1. Okay, this, when D-Wave, they were going public, this sounded reasonable. They're going to be worth, if they were maybe 340 million, not selling the whole company, they'd be worth, who knows what, but more than 340 million.
Yeah.
What's happened is the shares have not performed, the market cap has fallen, and now the debt is close to that 9.9% threshold. The
Right.
shares are having like a buck 40, and now you have, you're a chance of triggering the inability to get any more line of credit. Now, why is this a big problem in the near term? Um, D-Wave went public 6 months ago, and what happens when you're a public company? When you go public, lots of insiders have what's a lockup period. So that means if I own X% or my contract says I'm a major employee, I can't sell my shares when the company goes public, and I can't share until 6 months in. 6 months till the company's public. That 6 month anniversary is coming soon, and a lot of these big shareholders have shares at a cost of 2 cents. So even though even though the stock's at $1.40, $1.35, if I'm worried about the liquidity of the company, I'm worried about its future, and I can sell something that I paid 2 cents for $1, I can get 50x return. I'm going to do it. And what they'll do is they'll push the price down. So the more they sell, the more the lockup sells, the more the pressure's on the price, which can either then put the credit limit, either you're gonna hit your 10% threshold as a line of credit, or it's gonna be less than $1. So all of a sudden, D-Wave, who raised less than a SPAC, was ready. We range it back up $150 million, and I don't know how much they've drawn, may not be able to access their line of credit. So all of a sudden, they don't have cash to pull, and they won't be able to make their obligations because they've got some revenue, but it's not going to cover their expenses.
Right. And so when you say a series of unfortunate events, obviously, which led to this, things that they couldn't have obviously foreseen and prepared for that put them in this position, to go into the revenue, are they generating revenue? What's the situation there?
Like it's actually off a low base. It seems to be growing rapidly. They have 63 large clients, many of them you've heard of. The 2020 revenue will be around 9 million. It looks like a quarter of that will be coming. Half of that will be coming last quarter. So the 9 million revenue, it's impressive. They're projecting much bigger revenue 2-3 years out, and it does seem to be growing exponentially. But the problems, they had let's call it 4.5 million revenue in the first 9 months. Their expenses are 41 million. So you're basically burning $31 million, and their balance sheet and their line of credit will not support that right now.
Exactly. Oh, so what can they do here? Like what sort of the next steps here for them? Because it sounds like they're, in over their heads a little bit.
So, it's again, I'm no privy to what's going on in the company, what the discussions are now, but there must be a few things. Like usually at this point, they're like, okay, well, let's get a new CEO, let's figure a new business model, and we'll get new investors. Well, they have a new CEO, which came in, relatively recently, and he switched the business model. They used to be selling these huge quantum computers, and they went to basically more of an AWS model. Say, hey, we have the computers, you can access quantum in the cloud, and we'll do your models. And I think that's working. It's just not working quick enough. So either they have to cut costs significantly, and I don't know how much they can cut costs. I don't know how much they need to run their machines.
Right.
Or maybe they can do a reverse stock split, which will get their share above $1, but they'll still have the 9.9% threshold. So, if you're there, your options are kind of limited, and you have to find either another investor to give you cash infusion and probably sell a big chunk of the company, or you're selling the company, or you're going bust. And it'll be interesting to see what happens. It's not a great situation to be in.
Yeah. So I was going to say, I mean, we obviously are just like, we're sharing our opinion and our thoughts on what's happening, but it sounds like this could be, the ending of some long-term plan or of the company as a whole. But your take on just what this means for anyone that's listening, and what you think, I guess, the next year or so is going to look like.
So first of all, none of this is investment advice. So if you're thinking of buying or selling any financial instrument related to D-Wave, I have no advice on that. We don't give advice.
Yeah.
Exactly. So like all the legal disclosures that you'd hear in a normal podcast should come in here now. Look, this isn't. It's, to be honest, a bit of a sad issue from a sad perspective. This is a 24-year-old company that approached quantum by taking a bold perspective. They took a different approach to building a quantum computer than was the wisdom at that point, and it worked. They became a leader despite being underfunded compared to the IBMs and Googles of the world, and they actually helped make Canada's build Canada's reputation as a quantum leader. But my takeaway, eventually you have to, it's great to have a technology breakthrough. And what you see often is sometimes you're a bit too early, and someone has to take all the investment to make that breakthrough, but they don't capitalize on it if they can't get the business model to work. And this seems to be the case here. At least they spent too much time on R&D and pushing the technologies where they needed to go, probably, but they didn't get a business model that seems to work. Business model works when you have costs in line with the revenue your customers are going to pay, and the customers are going to pay revenue based on what they can return on investment. So while quantum allows you to do computing that you couldn't do before, what's that value? So what I'm not sure here is is just fundamentally, does the business model not work because their costs are too high to deliver the value to customers to see or not? So it's a reminder again, like lots of times you hear about great breakthroughs and they don't produce an initial business successes. It might take 10 or 15 more years to get the cost of quantum down, or people understand how to do what to do with quantum to actually deliver significant value.
Right.
So again, just reminder founders, building a winning company means having a competitive advantage and something that can profitably produce an ROI for your customers.
Mm-hmm.
Don't know exactly the whole story here. It's 24 hours in the 24 hours, 24 years in the making.
Yeah.
And for whatever reason, this company's always had a bit of trouble raising funds despite the heat of quantum. So that also reminds us that future technology can always be 5 years away.
Right. Right. And thank you. As you said, this was obviously not one of the more positive things we were talking about today. It is obviously a lot and very sad. And it'll be interesting to see what ends up happening or what the plan is going forward. So thanks for just maybe breaking down a little more of what all this might mean and your perspective on it. Before we move on to our next headline, I just want to call out that we do share these videos and also more of our takes in article form in our TechTO newsletter. And if you aren't subscribed, please do, techto.org/newsletter. I've been really enjoying recently in our newsletter. The co-founder dating is really fun. I know we have a few placements that we're going to be sharing over the next week or so. So great place to find your partner in business. Also getting to meet some of our speakers ahead of events. And I find I've had a few folks say to me, it's nice for them to have an understanding of their story a little bit before they can maybe come and have like questions prepared if they want to talk to them. So is there anything you're liking right now, Alex?
Well, I'm gonna plug something we should put in one of the future ones, because we're talking about D-Wave right now. We had Jordy Rose, one of the founders, speak at Tech Vancouver. The video's on YouTube.
Yep.
I think we should include it in the newsletter because it'll give some perspective. Jordy's left the company a few years ago, but it's one of our most viewed companies, and Jordy is a genius. So it'd be great, sometimes we surface videos that we recorded 5-6 years ago that people may not have found on YouTube because we haven't algorithmically made sure that we come on top of the search and resurface them when they're relevant. So hopefully we'll do that this week.
Yeah, there is a vast amount of content that we obviously want to be pushing out over time. So I'll not only share it, I think tomorrow's newsletter. Yeah, sure. Let's do it. And then also in the show notes here, just because we did touch on it, I will definitely link to the video so people can check that out. Okay, next headline. It's early into the year already in 2023, but Jobber has already secured the largest raise of the year so far. So what's the news there? And also for those that might not know, what does Jobber do?
Okay, so Edmonton-based Jobber announced $100 million USD round of financing led by General Atlantic. This is actually the first $100 million raise of the year, coming a little bit less often than they were last year, the year previous. For people that don't know Jobber, the best way to describe it is to use an analogy. It's like Shopify for home service providers. So Jobber provides a platform for HVAC, people that take gardeners to run their business. So, does anything from quoting to invoicing to scheduling. It makes their life, takes an industry that has traditionally been analog and helps them digitize their business.
And as you just kind of alluded to, right, with these a series of large rounds we're not seeing as frequently or haven't seen them really that often anymore. They're few and far between. So aside from that, what else is really notable to you about this round?
So I think if you read what the CEO said in in the press coverage of this round, he said it's 100 million plus USD. They have 100 million plus USD in annual revenues. They generated $13 billion USD in revenues for their clients. And more importantly, from my perspective, there's clean terms in this round, because I think a lot of larger rounds I see happening in the States, I hear that the terms aren't clean.
And what do you mean by clean terms? Like, what does that mean?
So, I think when we report on rounds, and what most people get stuck on is the valuation. And that's only part of the terms that matter. There's a lot of other terms. And I think in the height of the boom, lots of other terms disappeared. The one other term you'd see people negotiate is how big's the option pool, because that has an effect on the actual share price. But what disappeared, and we're seeing returns, what we called, there's terms either that give structure financially or over control. So let's give you an example. One that's a financial term is something called a liquidation preference.
Mm-hmm.
So a liquidation preference says, hey, we're going to invest X dollars. And if you sell, we need to get 2x our investment. So let's just make it clear. We're investing $50 million, and any exit, the first 100 million that comes out, because we need to get guaranteed a 2x return, comes to us. And then so you can think of it, okay, that if the company sells for a few billion, who cares? It ends up being the same percentage as it would be. But if the company sells for 110 million, and there's a 2x preference on the 50 million investment, that means the first 100 million goes to those investors, and 10 million gets split between all the previous investors and shareholders. So it's punitive. Other example of financial terms could be warrants or rights to buy future rounds at a discount. Could be protection if there's a down round, that you got to basically buy shares to make up for it. So you basically effectively get dollar cost average your shares down. And there's a bunch of other financial terms which put structure around the deal. Then there's control. They might actually ask for, maybe you only get one board seat traditionally, but now you ask for 2 board seats. Or you can say, hey, if the company can't do A, B, and C without the board's approval, which they haven't done before. So it's very interesting to note that Jobber pointed out that these were clean terms, because it's something we're not seeing as often right now.
Yeah, and because we're not seeing it as often, why were they able to raise clean terms? Like, what was their financial approach to get here?
So I think there's a few reasons. I think it's their approach to past financing, the value to create for customers in the market they operate in. So let's break it down to those 3 things. First, you look at the past financing results. Jobber has been appears to be capital efficient with its growth and has not maximized valuation any round. So what happened is money became easier and easier to raise. You got higher and higher valuations, which made it harder for the companies to grow into those. And because money was easy, the growth was expensive. So, hey, we're investing $1 and we're getting 20 cents in revenue versus, I feel, historically, you'd be saying we invest 50 cents to get $1 revenue, or $1 to get $1 revenue. And so I think it appears that Jobber either intentionally didn't overvalue their company, or they just missed the peak by their timing. And they've been capital efficient. So they don't have a valuation hangover, and and they were able to raise on clean terms. Now, if you also look at the, reading the tea leaves, because they don't tell what the exact revenue, they haven't announced the valuation, but I think I've seen a couple estimates in the valuation. They're looking at a 6 to 8 times last year's revenue, which is not, compared to, you'd see 70 times run rate in early stage companies 24 months ago. So this is not super high. But it, I always believe it's, you're better off with clean terms than a optimized valuation. And, so it means that they've given themselves for error in future rounds if they need more cash. Second thing, their product seems to work and create a significant value. The exact opposite of what we talked about in quantum. Again, D-Wave, we don't know what the value creates for its customers. Again, let's be clear, the 13 billion in revenue for 100 million plus revenue that expense means that their customers have $130 in revenue for every dollar they spend on Jobber. Now, I'm not saying all that $130 of revenue comes because of Jobber, but if you can imagine going from an analog process to a digital process, you create additional time, or you save time, and these customers can either make more revenue, have a bit easier life, or reduce expenses. So if their customers feel that, hey, out of that $130, $10 of revenue is due to what Jobber does, they're doing a 10x, and so it's going to make it sticky. It's going to be customers rave about them. It'll help with word of mouth. It'll lower churn. It'll help improve their metrics. Finally, the home service market is huge, and they've been late adopters of technology. This means that despite Jobber's size and number of customers, there's still a huge opportunity for Jobber to grow. So the growth doesn't seem capped. So there's lots of upside. And I think the market size is interesting, because I think market size is one of the hardest things to estimate for a startup. Like if you would look at Airbnb early rounds, you'd be like, oh, how many people want to stay on someone's couch?
Exactly. How does this make sense? Yeah.
And so I think, there's more, let's call it fungibility around market size, but now there's a premium being paid for someone that has an obviously clear market for something that's working.
Yeah. And so just lastly, it's great to see sort of, I guess, this end goal or this achievement being published and people are reading about, but we know it's obviously not easy to get to this point. There has to be, an ABC all the way before you get to XYZ, which is this point in time. So what are your takeaways? And I guess what advice would you have for anyone that's maybe in the early ABC phase of things?
So I think we've said this many times over the last few years, but You know, building a startup is a marathon.
Yes.
And over the last few years, a lot of people were sprinting to wins or local wins, announcing huge valuations, um, with big proclamations. But just because you're leading the race early on doesn't mean you've created something that's going to win the marathon. And what I mean here by winning the marathon is you create a sustainable business that's by default alive. So either you're cash flow positive, and then either you go public or get acquired, but you create something that's creating economic value for your customers, economic value for your shareholders, and it takes a long time to build that because so it's sometimes you just have to. There's periods where you have to grind, and it's not and it's nice to get those quick victories,
Hmm.
but then at the end of the day, it's where you end up. And I think being capital efficient and driving value for customers in a huge market is not sexy, but it's the best way to win, right? So like I think if you
Right.
look, like I said, like there was growth, and we've discussed this a few times, like growth at all costs was what was happening a year ago, and everyone was getting rewarded for that. But like at the end of the day, if you're paying a lot for growth, you have to believe you're generating either huge margins and it's sticky and customers will stay around.
Hmm.
But if you can be more capital efficient, it takes a lot of risk out of the business. And if there's a lot more space for you to grow, you're going to be more valuable.
Absolutely. So slow and steady can be frustrating, obviously, but there are those important things to consider. So that's a really important takeaway, I think, because it's easy to just see, oh, all of this looks great on paper, but it's the little steps that you said aren't as sexy that you have to pay attention to and worry about. So that's great. Before we end, we have a bit of a lightning round. So just some quick hits to talk about that were making news. So Shopify in the news again. They made another investment, and also New School Foods. Can you maybe talk about the investment that Shopify has recently made and what's happening there? Let's start with that.
So Shopify, according to the beta kit, Shopify has made an investment into United States-based Triple Whale Series B round.
And what's Triple Whale? Just before we get
Okay.
maybe a little further in.
Triple Whales has a data platform that allows Shopify store owners to unify their business metrics into one dashboard. So it makes it easier for them to understand what's going on.
And it's obviously interesting. Shopify is still investing in technology, but why else do you think this is interesting news?
Well, it'd be very easy for Shopify to not invest right now. Their stock's down significantly, and
Yeah.
imagine. So they're either what they're taking cash off the balance sheet, which means there is more, and the cost is either up because either taking, even if they take out cash flow, if they need more cash, it's either a cost where they could be investing in and getting higher interest. They can actually get returns from an interest rate perspective, or they would be hypothetically, they could be buying back shares, which are less valuable now. So the fact that they still feel inclined to, invest means there's a couple things here. One, they want to imagine by investing, they can ensure that Triple Whale is
Mhm.
available on their platform, which, so it's a functionality they think that a subset of customers want, but they don't want to build in house.
Right.
And the second thing is, what I think Shopify has the ability to do by these investments, they can put their fingers on the scale to, if there's competitors to Triple Whale, to just favor Triple Whale a bit more. I don't know if they do this, but I think they'd be inclined to. So it's interesting to see that they're still using the might of their platform
Mhm.
to, or their balance sheet, to encourage development of their ecosystem and ability to anoint winners. And we'll see, because in the past this paid off really well for them as companies got later stage, because they helped them grow faster and they have
Exactly.
bigger values. And so we'll see how this plays out.
Yeah, exactly. We'll see how this plays out. And just the second piece of news. So, what's the news around New School Foods? And also, the headline might be a giveaway, but what does New School do also?
So according to TechCrunch, New School Foods closed a 12 million USD round led by Lever VC and Blue Horizon with many
Mhm.
other investors. They're producing whole cut fish alternatives that look and cook just like ordinary seafood.
There you go. I was going to say that's why the headline might have been a giveaway. I thought it was very creative, and that was your idea to do that. So that was just a cool call out for you. And I'll just lastly, why is this interesting?
So it's multifaceted reason it's interesting. First of
Okay.
all, it's a second time founder, Chris, Soto's last startup to Instacart, knows the food space.
Hmm.
Um, there seems to be a downturn alternative protein space, and this is a pretty large, let's call it seed round. So this, you've got the credit of a second time founder and maybe it's a bit of blue ocean space, before in the protein space that allows them to still raise. And I think what's more interesting is if you read about how New School developed its technology, it's not like Chris had a specific idea and approach. He said, hey, we did a call out to universities and private institutions saying, we'd love to see proposals on how we could accomplish what we want to accomplish. And then they had a bunch of proposals and they funded 6 projects and with the right, I guess, to leverage IP. So, and I actually was talking to Chris last night, and his view is, this is just a start. He wants to build a platform to produce all sorts of alternative proteins.
Right.
And I think, the ability to almost do a contest or fund what's happening in institutions is a great way to leverage technologies out there, but hasn't been commercialized yet. And I think it's a very interesting approach to get new stuff to market.
Exactly. And that's interesting that you obviously got firsthand perspective on sort of what the plan was and what they were looking to do, especially maybe over the next year or X amount of months. So that's great. That's all I have in terms of what we want to talk about today, just what was relevant in the news. Before we jump off and I let you go, I just want to highlight some of the upcoming events that we have for the community. So we have a TechTO Talent coming up on February 22nd, completely virtual. You can register on our social and on our website. That's a really great place to just meet other like-minded technologists, learn from employers who are hiring now, or even just potentially find an opportunity if you're looking for one. So whether you're hiring or you're looking to be hired, I would recommend that event. And we also, February 6th, our last event was hugely successful, and all of that content will be going live in the coming days for those that couldn't attend. But we do have an International Women's Day event on March 6th at 1:11, and also a TechTO special Web3 series on March 22nd. Is there anything out of those two that is particularly exciting you, Alex?
I think I always like the March 8th, the one with the women in tech, because I think we always have, strive to have an inclusive lineup of speakers. Mm-hmm. But I think this one, usually we highlight some speakers that are not well known or people in the ecosystem. So I'm looking forward to that. It feels like it's a long time away, but it'll be here before we know it.
Exactly, less than a month, and it's always great to celebrate, the great achievements and stories of women in the tech industry as well. So that being said, thanks so much, Alex, as always, for helping us break down the takes and for joining us and sharing your perspective with the community. If you liked this episode, don't forget to like and subscribe wherever you're watching or listening. You can also catch up on previous episodes on our Spotify, Apple Podcasts, or wherever you listen to your podcasts. And we will see you in 2 weeks' time. And until then, we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea. So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.